Welcome to the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Hey everybody, thank you for joining us back here on Teaching Tax Flow, the podcast, looking down the aisle of, should I say, listening to, looking down the aisle of works too. Looking down the aisle at episode 37. Today we're going to talk about how to earn $500,000 tax-free. So, no more details, no more hints. We're going to jump into the show here in a minute. Me and Chris are going to have a great discussion on this topic. Hopefully your ears are perked just a little bit. But before we do that, let's take a moment. Thank our sponsor as always.
This podcast is sponsored by The Mortgage Shop. Are you looking to qualify for an investment credit loan without jumping through hoops? That's easy. They have loans with LTV up to 89.99%. Exploring their products and discovering how they can work for you is simple. Just visit mortgage.shop or call 865-325-2566 and tell them TTF sent you.
Hey everybody, welcome back to Teaching Tax Flow, the podcast. If you can read at all, obviously you've seen the title of this show. It's earning up to $500,000 a year tax-free. Now we're going to talk about earning it. We're not going to tell you how to earn it exactly. But before we do that, I'm John Trapolsky. If you haven't heard my voice before, congratulations. Now you can. But even better than that, I have Chris Picciurro with me again. How's it going, buddy?
I am great. Always fun to be on the show. If they haven't heard your voice, John, that means they need to go back to episode 1 and start from scratch here at the Teaching Tax Flow podcast. And if you hadn't heard our voice, welcome to your first episode.
Right. And if they haven't heard us at all, Chris, I usually don't kick people off of our show, but if you haven't, press the stop button right now. Don't listen forward. Move on back to 1. You got hours and hours and hours and hours and hours of content to listen to. But before we come up with any more corny jokes, drive each other insane, Chris, let's talk about this a little bit, right? We're not giving anybody a roadmap to say, you know what, this is how you make $500,000. Go pull couches off the side of the road, sell them on Craigslist, sell them on eBay. We're not going to tell you how to do it. We're basically going to tell people how to keep it. So give us a little bit of a preview on what we're looking here.
We talk in Teaching Tax Flow a lot about diagnosing and prescribing different tax strategies and legally and ethically reducing the tax you pay in your lifetime. There are some tax loopholes out there that enable taxpayers to earn money tax-free. One of the 3 laws of Teaching Tax Flow is that tax agencies are your involuntary business partner. Tax rules are written to encourage and discourage certain behavior. And one of the tax laws that were written, which we refer to as Section 121, allows you to exclude up to $500,000 if you're married filing jointly of capital gain when you sell your primary residence. We're going to dive into some of those rules coming up here. But what's important to understand, first of all, is why do we have this rule? Well, we have this rule because, and spoiler alert, one of the qualifications is that a property has to be your primary residence for 2 of the last 5 years to qualify. Okay? John, let me ask you a question. I'm sure you got all A's in social studies growing up, in American history.
Of course.
What is the term for someone that is elected in the House of Representatives of the United States?
You know what? You would ask me a question like that. It's like you looked into my brain and said, you know what, idiot? You really don't remember a whole lot from that class. So, whatever. You answer it. You're smarter than me. I hang out with better looking, smarter people.
Well, I don't know about that. I would say your family has, but it's 2 years, right?
Okay.
So a congressperson could win their congressional district. They can go to D.C., they can buy, or Virginia or wherever, they could buy a property. They could live in it for 2 years. They could lose their election the next time coming up, and they could sell their property. And guess what? They could walk away with, if they're married, joint, $500,000 of profit, or unmarried, $250,000 of profit. So it's kind of a nice going away gift for someone at the House of Representatives. Well, guess what? There's a lot of people that do that in their own personal lives. So Section 121 of our tax code, again, allows taxpayers, and we're going to talk about eligibility, to sell their primary residence. Now they do not have to buy another residence. Previously, John, when I first started practicing, when I had a hairdo over 20 years ago, you used to have to buy another residence for up to that value. You don't have to do that. You can go rent a place. You can go live on a dinghy in Key West.
Back when you started, I mean, that was a while ago. Where was Coke sold in glass bottles, and there was cigarette pull machines at the bars?
No, but Moby Dick was a minnow. It's that long.
Oh, there we go. Okay, you made it. You always open up the can of worms, or I should say the head of hair jokes. So we obviously move forward.
We need one bald joke at least, and don't worry, we'll do pickleball into the start of that podcast just to get under your skin.
Hey, you know what? Just like your process, with tax forms. I mean, you're pretty aerodynamic. You're pretty streamlined. So
I am. We are efficient. So what we talk about is in the teaching tax flow world in our community, goal diagnosis. So if you're in a 30% marginal tax rate, $400,000 of taxable income would cost you $120,000 of tax. But if it's tax-free, goal diagnosis, like the Section 121 exclusion is, it would cost you nothing. Now, when we talk on this podcast, we're going to focus on the tax part of this decision. A lot of components come in to play when you're deciding to sell a property, buy another property, move, downsize, et cetera, et cetera. But we're going to just keep this down to, what are the eligibility issues? Where can we find this information on the IRS websites? And we're going to link all that to our show notes and some other considerations.
And as we jump into these two, Chris, before we start giving some, little deeper dive explanations, a moment ago too, you mentioned loophole, right? So if anybody is not familiar with that term, let's not, I should say, correlate or associate loophole with sketchiness, right? So taking advantage of these loopholes is not an unethical practice. It's not, kind of skirting the rules. It's there with intent. It's actually, if I'm not mistaken, they're all outlined really in a sense by the IRS. It's just the fact of actually following through with it, correct?
Yes. And I would say there are a lot of interested parties in this Section 121 exclusion, not only the Congress people, but also, or how people in the House of Representatives, the Mortgage Bankers Association, the Association of Realtors. Think about whenever there's a house bought or sold, there are several people that are compensated, and there's money put into local economies. So it's not that this is just a zero-sum game. Every transaction you would have an inspector, you would have an appraiser if you have a mortgage. There are a lot of pluses within a local economy whenever one of these transactions takes place. So that's kind of some kind of, if you throw a rock into the water, you see all those little ripples. There's a lot of ripple effect of having this tax law. And it allows people, quite frankly, to take whatever proceeds they have from the house they sold and move that into another property if they so choose. But again, you don't have to buy another property to take advantage of Section 121 exclusion. So for those listening, obviously don't pull this up in your vehicle if you're driving. But what we're going to really focus on are the contents of Publication 523 put out by the IRS. Now, again, this is not Nobel Peace Prize winning literature here, but I think talking with some eligibility.
You would probably use it as bathroom reading, right? I mean, I'm sure you print off, flip through it, right? You might be the only one, but somebody.
Oh, well, maybe.
That's the most subtle. Yeah, okay. I got a couple of copies I've ever heard.
Now we fiddle around on our phones. I don't know what we do. But anyway, so eligibility tests. So ultimately there are a handful of eligibility tests to determine if you sold your property, would you be able, with your primary residence, be able to walk away with tax-free income? All right. We get this question a lot on the Teaching Tax Flow podcast as well. So the first eligibility is there is an automatic disqualification if you acquired this property through a 1031 exchange or like-kind exchange. We talk about that a lot in our Defeating Taxes private Facebook community, defeatingtaxes.com, definitely bookmark it, or in prior podcasts. Also, if you're subject to an expatriate tax, you are automatically disqualified. What that means is that's someone that has left the country. Again, we don't want to dive in the weeds too much, but someone that has decided to take residency and citizenship elsewhere. Second step, you actually have to own the property, right? Just because it's your primary residence doesn't mean that you automatically meet that 2 out of last 5 year requirement. So John, let's say you rented a property for several years, you bought it after renting it, and then you only owned it for 1 year, yet you lived there for 3. You have to have ownership in the property for at least 24 months out of the last 5 years leading up to the date of sale. Now, it doesn't have to be 24 months straight. It just has to be 24 months in that window. And this, a lot of times when you have snowbirds or you have people living in 2 different places, this could really play a role. So that's the second step. The third eligibility is residence. You've got to determine if you met the residence requirement. Are you there once in a while? Many people have second properties, a beach house. How do you prove residency? Again, it's a facts and circumstances situation, but do you have your voter's registration card there? Do you have your driver's license? Are your vehicles registered there? Nowadays, one of the tests would be, well, do you bank somewhere? Well, many of these banks are in several states. But if you owned the home and used it as your residence for at least 24 months of the previous 5 years, you're meeting that residence requirement. But that 24-month period, like I said, it could vary. It could vary. It doesn't have to be continuous. And there's some special rules. Again, we're not going to dive into too many of the special rules, but some considerations would be if you're away from the home for a long period of time, like a vacation or a short absence really isn't going to play a big role. But what if you leave for 6 months and run around in an RV? I mean, that's a consideration. Another consideration is what happens, what happens if you become physically or mentally unable to take care of yourself and you have to leave the home or go to the hospital. So again, those always play a role in that residency eligibility test. The fourth one, so you do get a certain amount of, we love Monopoly on the Teaching Tax Flow podcast, so you get a certain amount of get out of jail free cards. As you said, John, this doesn't imply that you're going to go to jail if you use this, but you don't get an unlimited amount of Section 121 exclusions. Because in theory, you could have 2 homes that you both lived in 2 of the last 5 years and sell them in the same year. So there's a look-back eligibility, and you have to meet the look-back requirement. So if you didn't sell another home during the 2-year period before the date of your sale, you meet the look-back requirement. Well, so basically, you've got that 2-year window that if you have multiple properties, this would only play a role as if you had multiple properties and you lived in both of them for 2 years, which, John, I know you live up in Michigan. There are a lot of people in Michigan that spend 5 months down south and 7 months in Michigan.
Those are what we call smart people. Get out of here when it's cold.
Exactly. And that's so that's where you could realistically have 2 houses that you meet the eligibility requirement for. The fifth eligibility step is, do you meet one of the exceptions? So let's say you fail one of the first 4. If you failed one of the first 4, you might meet what's called one of the exceptions. And that's where it's really a facts and circumstances situation. We always talk about in Teaching Tax Flow, don't let the tax tail wag the dog. But you also want to know the tax ramifications of your decisions. So, did a separation or divorce occur when you're in the home? Did a spouse pass away? Was your home destroyed or condemned? I mean, we've had situations where a home was burnt down, but the taxpayer wasn't there for the full 2 years. Or there was an eminent domain case where a bridge was being built and the home was basically taken by the government because of eminent domain. So there's a lot of, if you were a service member, there are some special rules. So there are some exceptions to that eligibility test to be considered that maybe you might meet one of those. The most common would be the separated or divorced taxpayers, or unfortunately, a widowed taxpayer. So
basically like you get a bonus point.
If you fail, I guess it's a retake, right? If you fail to one of the eligibility tests yet you meet an exception, then you're back in business. And then there's other considerations of there's circumstances where you could be getting a partial exception. Exclusion of capital gain. Those things occur sometimes if you rented out the property for a portion for a certain period of time, and then you lived in it for a certain period of time. So it's not always hey, I get the entire exclusion or none. Sometimes it's partial.
So a lot of these may apply to somebody who, say, takes a 6-month out-of-state contract for employment, moves back, but obviously over that 24-month period of time, they've spent the majority of their time there at their primary.
Right. What if they would have rented that primary out for a certain period of time? Exactly.
And hopefully they don't come back and it's condemned, eminent domain, and they got a divorce, and there's a lot of boxes you can get creative and check, but
we're seeing that a lot with interest rates. So sometimes taxpayers are locked into a very low interest rate with the property. They don't necessarily need the cash out of it to move, and they want to create some cash flow for themselves. Now, again, they're converting a primary residence to a rental is a serious consideration with some negative tax consequences to be considered. So definitely talk to us here at Teaching Tax Flow or your tax professional about that before you make that decision. We're not going to jump into the basis. We're not going to jump into that in this podcast, but it's something to consider. When we're talking about the partial exclusion, obviously, if you rented the property out versus utilize it on your own, that could be a partial exclusion situation. If you had to move that and it was really work related, that could give you a partial exclusion. So let's say you didn't live in the property for 2 years. It's a newer property, but there's a work related move, there's a health related move, or some type of unforeseen circumstances we talked about. It's funny as it sounds, if you lived in a home for a year and a half, let's say taxpayer becomes pregnant, it's a starter home, it's a 2-bedroom property, and taxpayer has triplets. That actually could be an unforeseeable event that allows them to take a partial exclusion.
That's an interesting one.
But yeah, it is. I mean, so we've seen these things happen. One thing, though, when we talk about a gain, a cap, because when you sell your property, assuming you sold it for more than you paid for it, you have a capital gain. One thing to consider, though, is that one of the concepts is cash flow versus cash flow. The money you receive at closing is not your gain, right? It's not your gain.
And explain that in a little bit more detail for those that aren't familiar how everything is with that. Because that's a very important concept that you mentioned and we talk about a lot, right? Tax flow versus cash flow, or cash flow versus tax flow. So let's chat on this.
So let's walk through a really rounded example of, let's say you bought a property for $600,000, and let's say you were fortunate enough to pay cash for it. And let's say you sell it 4 years later and you're married, joint, for $1 million. And let's say you have closing costs of $50,000 and you put $50,000 into the property. Okay? So your gain is $300,000. $1 million minus $50,000 of closing costs is $950,000. Your basis for that property, basis is your cost basis, what you paid for it, is the $600,000 you paid for it. And you put $50,000 of improvements, you have a $300,000 gain. Assuming you meet all the all the eligibility requirements, you walk away with a $300,000 gain, but at the closing table, you don't have a mortgage, You sold it for $1 million, $50,000 of closing costs. You actually walk away with $950,000. We've seen people come into the defeating taxes community, teaching tax law community, say, "Oh my gosh, I just sold my primary residence. I have $950,000 at closing, and that's over that $500,000. I'm going to owe a bunch of tax." No, that's not the case. That what you get at closing really is more of a result of if you had a mortgage note on the property and that sort of stuff. The other thing to consider is we talk about cost basis for these properties, these primary residences. It's not just what you paid for the property. A lot of times, especially with new construction, you might have landscaping costs. You might have built a fence. You might have some capitalized improvements, or even if you bought an existing residence that needed some work. All of that really plays a role into the basis. And we're talking at a federal level. Final thing I want to talk about just from considerations. Each state is different. Most states comply to the federal Section 121 exclusion. But those are considerations. And that's why when people say, well, should I keep all my receipts? Yeah, we don't need flood loads of receipts, but at least keep a log with these major home improvements.
It's funny that you mentioned saving receipts, right? I feel like I just heard a story from somebody, might have been a friend of mine or something over one of the past holidays, and they said, "Oh, I kept all my receipts, for X number of years, and I felt really confident." And then they go to open it up, and it was all thermal paper, I believe. So what had everything on it, they open it up, and they're all blank.
Oh,
like so basically, you got a bunch of ribbon tape with nothing on it. It's all black. But Chris, kind of circling back, just one more time a little bit to our title of this, right? So earning up to $500,000 tax-free. Again, we're not telling people how to make $500K. We're telling you how to basically keep it. So that example of using, defining what capital gains is obviously is very important, and really defining on or breaking down, I should say, how you get to that total is very important. So if they make a rewind button for a purpose, go back and listen to that if you're still confused.
Exactly. So think about this. Here are our action items. 1, understanding that the money you get at closing is not your capital gain, and you need to figure out what your cost basis is. Your cost basis could also include a step up in cost basis, meaning if you're a widowed, or if you inherited the property and lived in it. We don't want to go on a tangent about cost basis, but understanding that your capital gain is based on your sale price minus expenses and your cost basis. The Section 121 exclusion, there are certain eligibility requirements that most people meet if it's just their primary residence. If you've had mixed use or have a extenuating circumstance that caused you to move, you might be eligible for a partial. Who is eligible for that up to $500,000 of maximum exclusion? If you're married jointly, or if you're widowed and you sell the home within 2 years of the death of your spouse and you haven't remarried since then and you didn't sell any other primary residence. Single or unmarried folks, they still get an exclusion, but it's up to $250,000. Finally, there is a chance if a property had some mixed use like rental, there's still a partial exclusion available. The key takeaway is understand that before you sell a primary residence, really talk to your tax professional and determine the tax consequences of that decision. And remember now, with current law, you don't have to go and buy another property to complete the exclusion.
Awesome. Well, that's a good jump into the detail, Chris, as you had mentioned before too. There's a lot more detail in each section of that we could dive into, but that's probably the best. In all the years I've known you, that's probably the best explanation that you've given, even me just chatting with you about it on how all this works too. So, and things change. Obviously, every year there could be amendments, adjustments to tax law, but is this something that's kind of been in play for a while? Have you seen a lot of changes with this, or just some small stuff here and there?
The biggest change was quite a while ago, is when you didn't have to reinvest into another property. Obviously, we've got elections coming up here, And we just carefully watch, who's running for what office. This would be a major change for this to shift. There's always talk about, let's put it this way, in my professional opinion, I don't see the exclusion changing, except for maybe capping it at a certain amount of, someone over a certain amount of income can't take it. But remember the people at play. Tax laws are written to discourage certain behavior. You don't want to do something that's going to hurt your friends at the House of Representatives. You probably don't want to, in general, politically, it'd be tough to change this law because of the realtors, the mortgage folks, the bankers, all the industries, big industries that are involved in this type of transaction. So
the positive ripple effect.
The big ripple effect. Yeah.
Awesome. Well, as always, if anybody has any questions related to this, which you may, and we welcome those, feel free to shoot it over to us in that Defeating Taxes private Facebook group. As I always say, here's your invite. Can't say we didn't tell you or invite you. So hop on into that, as well as if you prefer an email directly to our team, always feel free to reach out at hello@teachingtaxflow.com. And Chris, I know we talked a lot about unfortunate or unforeseen events. You guys seen it coming. This is the end of the show. So I know it's very unfortunate, but we will see you next week. Hey everybody, John Still here from the Teaching Tax Flow team. Couldn't get rid of me that easy. Although, would you really want to, right? You wouldn't want to get rid of us. We're here giving you tips. So all joking aside, what do you think about this past episode here that we did, the past, 15, 20 minutes or so, talking about earning up to $500K a year tax-free, right? So looking at it from the lens of, your parents or your grandparents maybe used to tell you, hey, a penny saved is a penny earned. So basically what we're telling you here is how to make more money, technically. Not telling you how to earn it exactly, but we're telling you how to keep it. We're giving you tips on how you can keep that income that we know you work so hard for. So hopefully you took some notes, got some good ideas, got a good strategy in place, or at least the tip of the iceberg when it comes to that strategy. So let us know what you thought. Drop us a line on our Facebook page, the Defeating Taxes private Facebook group. If you're not a member of that, this is your invite as always. Hop on there. Let us know what you thought. Shoot us an email, give us a call, shoot us a text. Any way to let us know what you thought about this episode, we want to hear it. If I remember right, this was a topic that was suggested also by a member of that Facebook group too. So great topics. Keep them coming. We have even, I want to say 2 or 3 really good ones. Again, I know I always say that, but I feel like we keep getting better and better with these shows, better content, better guests. Got some great ones coming up. If you like this one, almost a guarantee you're going to love the next ones that are in the pipeline. So again, thank you for myself. Thank you from the whole team here at Teaching Tax Flow. Have a great week. Keep on trucking. Bring us those ideas, and we will see you soon.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.